following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Joining me live today from somewhere in the Chesapeake Bay area, Blue Putnam. Blue, how are you?
Good. Actually, I'm cold today. I'm in Chicago.
Oh, you're in Chicago today. Oh, wow. You know what? Chicago was so cold. I didn't even go to our Christmas party last week. It was 74 here yesterday.
It's not 74.
Oh my God. All right. Well, that's yeah, no, I love Chicago, to be honest with you. I just couldn't make it because I had too many. My dad broke his hip. I have my cousin in from out of town. My kids are doing stuff. Just couldn't make the trip. Nope. I think I could you hear me okay?
Oh, yes. Loud and clear.
Okay, good. All right, cool. So anyway, well, it's been quite an eventful week. You know, yesterday, set aside the numbers for a second, Chair Powell seemed a little disheveled.
Yeah, nice choice of words. But he had a hard message to convey. It was a pivot. They're data dependent, and the data's been not cooperating, shall we say. And then you have President-elect Trump is quite active already, and he had to answer some questions about whether they're taking the potential future into the account. I mean, he hedged his bets on all of that, but clearly some of the FOMC members are thinking, hey, let's just cut rates and then let's go on hold and see what happens.
Right. I mean, there's two competing forces here. Data dependent means data is in the hopper. We could read it. We could understand it. Future events are future events that may or may not happen. They're two separate things.
Yeah, data dependent means you're always late, but at least you can look backwards and see what happened. Well, for the most part, of course, the data does get revised, so it's not even 100% probability. But the future is, let's just say the uncertainty is at a pretty high level.
Okay, so that makes a little more sense. It's kind of like Friday, 8 p.m. East Coast time. My Hoosiers are going to South Bend, Indiana to take on Notre Dame. And there's some uncertainty of whether or not we're going to win. I'm very nervous about this, but I'm going to project a victory right here and right now.
You can project, but hope is not a strategy.
Oh, I know. So in any event, though, I listened to the whole thing, and usually during a Fed's, when Powell is up on the stage, I'll have an equity market up, S&P, NASDAQ, pick your poison, and it oscillates up and down, up and down, up and down. Yesterday it was down and down and down and down and down. There was no up at all.
There's no up. No,
Yeah.
because when he, as he started, well, the statement came out, and then he started talking a half an hour later, and it was clear that the dot plot, was really very important early on, because that moved to only 2 rate cuts in 2025.
Yeah.
And so there's been a lot of controversy in the market during the quiet period before the FOMC that the market was expecting too many rate cuts, or more than would likely happen. And then that's what the Fed, or what Jay Powell communicated to us.
Yeah.
But those dot plots are a moving target, man. Every quarter they do them, and every quarter they move them. Their forecasting capability isn't particularly, let's just say I wouldn't trade on it.
Yeah, no, I know. But I mean, when he says stuff like, people are feeling the effect of high prices, not high inflation. That was a statement. It's like, wait a second. You're confusing the regular person here, right? We're feeling the effects of high prices, but not inflation?
Well, what's become a narrative in the market, and you can kind of take it or leave it, but it's being discussed a lot, is that the political public is saying, wait a minute, prices are still a lot higher than they were before the pandemic, which is absolutely true. The 1-year inflation rate is just below 3%. That's also true. But, you know, the economists are very wedded to 12-month inflation rates. The body public doesn't care about 12 months. They're like, they have a little longer memory, but you really don't want prices to decline, to go back. That would be a recession.
Yeah.
So,
But
you know, the public is worried, but you don't want that to happen. You don't want those prices to decline.
so you expressed that idea way better than he did, and so I'm going back to my point where he was a little flustered. The way you just casually answered that was it makes total sense.
Well, the thing is that we can talk about it and be a little bit political. He does not want to be political at all right now.
Yeah.
And it's very hard to talk about, you know, what the public is thinking and divide that in some way from politics. So I fully get why he was flustered and why he was in a little bit of disarray, but he'll be back on target next Jan. Well, actually, maybe not, because it'll be 10 days after the inauguration. He'll have yet another plenty of things to digest.
Yeah, no, that's sure. I mean, boots on the ground. And let's talk about food inflation for a second. Every year, me and Mrs. Kaggs, we go to Costco right before Christmas and we get the same stuff, the same basket of stuff for the Christmas dinner, the Christmas Eve dinner, the same stuff, right? And usually it runs around, this is Costco. Usually it runs around $340 or something. There's a lot of us. And, that doesn't even include the booze. But this year, same basket, $610.
Well, how many baskets?
Well, I mean,
You have two carts or three carts,
It was one big cart. It was one big cart. Anyway, so I think folks are
absolutely true. The CPI peaked at 9%. It's back down below 3%. But, compared to 3 or 4 years ago, that's what you're dealing with. Then that's the public opinion that we've still got to deal with prices.
Yeah. So going back to the SEP for a second, the summary economic projections, this is every other Fed meeting they have this, and 18, I think folks get to chime into their opinions. And they have these, what do they call them? The distributions. In addition to the dot plot, they have the distributions where they think inflation is going to be in 2025, PCE, core PCE. And it seems to me that part of the SEP is a little more stable and a little more common sense than the dot plots.
I think that's right. The dot plot, the one that, of course, bothered people the most was, where do you think Fed funds are going to be at the end of next year? Yeah. Whereas you're talking about, what do you think is going to happen long-term on inflation, long-term on unemployment growth? I mean, they only move their growth forecast, their real GDP forecast, 1/10, 2 to 2.1. I mean, that's like, why bother? But the policy rate expectation, that's the one that got the market's attention. But I agree with you. The inflation and the longer term economic output are pretty standard and don't move very much. Which by pretty standard, I mean, doesn't mean much.
Yeah, I mean, as I remember right, core PCE chart ticked up 0.1 to 0.2% for calendar year 2025 based on old calendar year 2025 projections.
Yeah, now that one was a little bit important because inflation is not going back to 2.
Okay.
And I think that was what the controversy was in the FOMC meetings. We're really stagnating now somewhere between 2.5 and 3, depending on which metric you look at. And and that means we're not going to the 2% target. And I believe, now my view on that is that we were able to stay at the 2% target, give or take a little bit, for like 25 years, 1994 to 1999, before the pandemic. And that was because of globalization. Globalization really kept a lid on prices. because during that 25 years, interest rates went up and down a couple of times. We had a Wall Street tech wreck in the 90s. Then we had a subprime crisis. And the core PCE stayed between 1 and 3 during that whole 25 years. That wasn't the Fed. And now we're going into a period where there's, globalization will always be with us because we're a global, we're a global community, but we're going to, we're in a world now where tariffs are going to be higher. You're going to have bilateral trade agreements, things like that. It's just going to be a different trade world, and that's not so good for inflation long term.
Yeah, I mean, Bank of England was unched on their decision today. ECB followed suit with us, but there seems to be a move afoot globally too to kind of slow the roll on cutting interest rates, except for Switzerland.
And Japan might raise rates another 1/10, but who cares? But yeah, because the world, Europe's in a very different place than the US. Europe is not growing as fast as they would like. And the countries that used to lead growth in Europe, like say Germany, are not leading it anymore. The countries that are leading it are, like Spain is doing very well. Italy's doing fine. The countries that are in debt this time around that are having trouble are France. And we've lost governments in both France and Germany in the last 30 days. Talk about uncertainty. So, they're in a more difficult position than the US. And, and that's been, so if the US is going to keep rates higher longer, that's not so good for the euro.
Yeah. Well, it might be good for me if I go back in the summer.
Right.
So, but Powell did say, I mean, he didn't pound his hand on the table. I thought he was going to, but he said, we won't settle for above 2% inflation.
Yes. And I was at a set of meetings yesterday in which there were a couple of former central bankers and a couple of really famous economists. And I won't drop names or anything, but I will tell you that the idea of going back to 2% all the way back just wasn't on the table.
Okay.
But there was an interesting discussion among this group about whether or not we should keep the 2% target.
Okay.
And that's interesting. There was a lot of difference of opinion there. Some people argued for a range. But most people said, well, you can't move the target very much because then the Fed would lose credibility. But you do want to don't aim for 2.0, give it a little bit of room.
Well, I mean, they by doing this, they tether monetary policy to a fixed 2%, regardless of the paradigm of the world. I mean, this is a fixed point we're going after. Doesn't matter what else happens in the world. This is how we're going to tether our policy to, and that doesn't have a lot of flexibility associated with that.
No, and if you look back, I mean, it's an arbitrary number, largely engineered by Professor Milton Friedman in the 1960s. We think he wrote it on the back of an envelope, but later on he actually wrote some articles about it to justify it, and it got locked in. In the Federal Reserve, every 5 years, they issue a policy statement about their monetary policy targets. And on unemployment, they always say there's just too many factors, we can't set a target. But on monetary policy, they say, look, monetary policy is the biggest influence on inflation, and we can set a target. And they reaffirmed their 2% target. There's a lot of debate in the economic profession about the impact of monetary policy on inflation. Everybody still thinks that it's a big impact, but it's not as big as it used to be. And you're making a mistake if you don't consider fiscal policy, which of course takes you into the world of politics where the Fed doesn't want to be.
Apparently, nobody considers fiscal policy. We just had another extension on the there was another 30-day, 90-day extension, and farmers got another $10 billion subsidy.
That thing hasn't gone through.
Oh, it hasn't. Okay.
No, there's a big fight over that. Congress did negotiate a bipartisan deal, but let's just say the wealthiest person in the advising President-elect Trump, and President-elect Trump decided maybe they didn't like the deal. So there's some probability that we will have a government shutdown next week because they just can't agree.
I wouldn't have thought in my wildest dreams that you have this bipartisan effort. It's done. President's still the president, like it or not, and it's not happening.
Well, it's going to be a very exciting couple of days in Washington. I know there's quite a few people in Congress in Washington that don't want to shut down over Christmas. The last time it happened, the president was Trump when we had one over Christmas, and it lasted 35 days. By the way, government shutdowns only affect about 1 million federal workers, which is a pretty significant number, but it's what they call non-essential employees. So,
Okay, so the airport, so the flight controllers are still going to be in the towers. Planes are still going to be moving and getting people to grandma's house and back.
Yes, but some of the workers at the FAA headquarters may not be in the office.
Okay, as long as travel's not, I mean, that would be the worst case scenario, right? You can't get on a plane at Christmas.
Well, that's what actually ended it, because the last time we had a very long work stoppage because of these budget impasses was the air traffic controllers. They were on the job, but they weren't being paid. And they know they're going to get paid. The government always gives you the back pay, but if you miss 4 paychecks or 4 weeks of pay, you can get kind of upset with things. So there is a limit to, but I think over the holidays, you will get your flying in if you want to.
Yeah, back when I was a young man and I worked for the federal government, when we got furloughed, we loved it. It was like we didn't get our paycheck, but we knew we were going to get back pay, and we had this extra vacation time.
Yeah, that means you buy Home Depot and Lowe's, just to fix up your house. These are not good things to do. I mean, to shut the government down is a serious indication of dysfunction in Washington, which we already know we have. And we'll just see what happens after January 20th. But unfortunately, we might be looking at a shutdown. You can't rule it out.
Yeah. All right. I was unaware of that. I just assumed it was, a done deal.
It's never a done deal until somewhere about 10 minutes after midnight on the very last deadline.
Oh my goodness. In any event, let's talk a little bit about the evolution of Fed funds rate expectations. Kevin, if we could shoot up there we go.
Yeah, this is a chart that shows the end of year for 2025 as estimated by federal funds futures market. So the CME Fed funds futures. And in the last couple of 4 or 5 weeks, we've seen this creep up toward 4%, which is the implication of only 1 or 2 more rate cuts in 2025. If you go back to September, we were looking at 4 or 5 rate cuts. And that was because we had some very weak data in August, and then it came back strong. And so now we're looking at much stronger data, and the Fed's looking at the same data. And of course, as we already discussed, they're being uncertain about next year. So, hey, let's just take it easy.
Well, the folks in June were nailing it. I mean, we're only like 1 or 2, 25 or 50 bips away from the forecast now.
That's right. Take a look at the next chart, though. It goes with it. The red lines are every FOMC meeting. And so there's a little bit of history there, but basically what you can see is next year it flat lines out. Maybe there's a cut, maybe there are 2, but there's not much happening in the way the Fed funds futures are working.
Well, but that begs the question, then have we found the neutral rate?
That is correct, actually. The Fed is comfortable with where they are now, or maybe 1 notch lower, as a neutral rate until something changes. And there are two things they're watching is, there's some people that think inflation might tick up a little bit. I'm not in that camp. And then there's some people that think, maybe we get a recession. There are fewer of those people than there used to be. And I'm not in that camp either, but, I'm waiting to see what the deportations and the tariffs look like. And I might change my view depending on, I'm data dependent. Well, I'm policy dependent. We'll see. So things will almost certainly change. And when they do change, the Fed will change and the market will react. Let's take a look at the yield curve. I think that's next.
But wait, hang on. Think of GDP's third estimate or second revision, depending on how I want to look at it, ticked up like, I think 0.2% to 3.0%, if my memory serves me correct on this last report.
Yeah. So no, we had a pretty strong third quarter.
Yeah. But how stale is that data? I mean, it's just December. Your third quarter ended, I don't know when. It ended September.
It ended in September.
Yeah.
So that data is seriously stale. And, the most recent data is way more important. So real GDP data doesn't count for very much at all anymore. We're looking at the weekly unemployment claims. We're looking at the monthly payroll jobs numbers, things like that are a little more current, but they're still lagged.
Yeah, I mean, that's so. Again, you got the New York staff Fed nowcast and the Atlanta Fed GDP now, and those two kind of track pretty closely usually.
Yeah, they track, but as I understand it, they're still only using available data. They're just using a lot more data. What's your last auto sales? What's your last personal consumption piece of data? All that. So that there's more data in there. Some of it's a little more current. But by the way, if you track those nowcasts, they move all over the map during the quarter.
Yeah, I know. Yeah, because they're input sensitive, right? So number comes in, shoots into their calculation, answer comes out, and it could be jarring.
Could be. I mean, I use for my own purposes, I use what some people call a Bayesian technique, but it really is, we average things, but in a time-dependent way. So the most recent data counts for more, but we take a little bit of view. It takes a big change to move the forecast very much, because you're uncertain. So you don't let one piece of data do too much damage to you.
So, but is GDP the official gauge of when we're in a recession?
No, interestingly, it's not. In the political opinion, 2 quarters of negative GDP is a recession. But the National Bureau of Economic Research has a select committee of economists that meet to actually date recessions. When did it start? When did it end? Sometimes they can take 3 to 6 months, even longer after the recession's over, to put the dates on it. But they look very, very heavily at personal consumption, things like that. They want to know if people are really hurting or not. And real GDP is not always the best indicator of that. The only recession I'm aware of that the National Bureau of Economic Research called a recession that did not have 2 GDP quarters negative was the one in 2001. We only have 1 negative quarter. But that's pretty rare. So the 2 GDPs in a row if they're both negative, we're probably in a recession.
It sounds like we have an official agency that declares recession or not recession.
We do. I mean, it's an officially unofficial one, but it's what we all use.
Yeah, I got it. All right.
I mean, they spend way too much time on it, but that's what they do.
Yeah. All right. Let's keep rolling here. We got. I think we have time for the next slide. Let's do it.
All right, this is the yield curve. And this actually gets to your point of whether we're in a neutral rate or not. I have 2 criteria for neutral rates. One, I think it needs to be a little bit above the inflation rate, check. And the other one is that you need to have at least a slightly positive yield curve. And that we now have. With the latest move, the Fed funds rate's probably going to trade around somewhere between 425 and 432 or so. The 2-year is at 432 this morning. The 10-year is at 455. So we have a slightly positive yield curve. And so that's a check for me too. So we're very, very close to what's probably a neutral rate.
Yeah, when we started broadcasting this morning, I think the CME group's I look at the CME group's micro yield 2-year and 10-year. It was about a 27 basis point separation at that point when I looked at it this morning. So it did seem like it was widening.
Yes. Now, the Federal Reserve did make a technical adjustment yesterday. They lowered the interest rate that they pay on reserves that you hold at the Federal Reserve. I shouldn't say you, because you and I don't, but lots of institutions do, including our friends at CME. And so that rate is going to be very close to the bottom end of the range now. And the range is 425 to 450. So 425 is, that's as low as Fed funds are going to go. They'll probably trade a few basis points above that.
So, but what does that mean? Does that mean that people take their money elsewhere or no?
No, it just means that the Fed lowered its target range by 25 basis points. It lowered its interest on reserves by 30, which turns out to be a slight, very slight additional ease.
I got it.
Getting technical here, it really doesn't matter much unless you're in that market.
Yeah. All right. Well, I read Zero Hedge sometimes, so that, they'll tell me if it's going to be a conspiracy theory or not. Anyway, so I got some good news and bad news. The bad news is we're going to have to take a break. The good news is I talked Blue into hanging out with us for the next segment. So let's take a really quick break. We'll get right back to it. All right, folks, we are back. We are still joined, thank goodness, with Blue Putnam. You might remember Blue. He was the former chief economist of the CME Group before he retired. Now he's with Bayesian Edge. And Lou, thanks for hanging out with us for another segment here.
Oh, all good. We got lots to talk about today anyway. That was an interesting day yesterday.
Oh, for sure. For sure. I did scroll to the next slide
yes.
On this 10-year Treasury yields through December 19th, 2024 sheet here.
Yeah, I like to look at this because I've drawn lines here between 3.5% and 5%, because that's, since interest rates, since inflation surged, that's really been the range we've been in. And back at the end of 2023, we ticked up as high as 5% on the 10-year. And we went down almost to 3.5% only about a couple of months ago. But I can tell you that when I am asked to forecast this particular number, I look at nominal GDP. So that's real GDP plus inflation, but all in one number. And, that's running a little bit above 5%. So, the movement toward the higher end of the range seems to me to be justified by the strength in the economy and the stagnating inflation rate between this 2.5 and 3.
Yeah, so that's interesting you say that. I was looking at this morning and I noticed that, the 10-year yield peaked in May, and then we've had 100 basis points of rate cuts since, and now we're right back to that same level. And intuitively, that doesn't make sense until you start thinking about, well, it's the longer end of the yield curve, and other factors are more important.
But when it peaked and then we got the 100 basis points of cuts, that was, most of that period, we thought we were going to get another 100 basis points of cuts in 2025. And now that's off the table. So the future has changed, so to speak. Where's Yogi Berra when we need him?
so the expectations have changed, right? We don't know. There could be 200 basis points cuts for all we know, but right now the consensus is here's the expectation there, and then that part of the yield curve is reacting to that expectation.
Yes, and I'm very much in the camp that there are two scenarios out there. Scenario number one is no recession, 2.5 to 3% inflation. In that scenario, you're probably between 425 and 5 on the 10-year. Okay. The other scenario, which isn't very popular right now, but my calculations are that about it only has a 15% probability among market participants. And they're going to be wrong, but that's that's kind of where the consensus would be. And that's the recession scenario. If the Fed sees a recession, we're going to go down and trade, 2% on Fed funds. We're going to break through that 3.5 going down on the 10-year. But that's down to below 20% probability, maybe closer to 15, based on the way I calculated about what market participants, how they're trading.
And that probability is based for calendar year 2025.
Yes. I have to make a number of assumptions. I posted this on LinkedIn a couple of weeks ago or 2 weeks ago. But anyway, the idea is that when you have two different scenarios, and the Fed really does think this way, man. If we have a recession, they're cutting rates. Okay, they're not going to wait around because they're going to believe inflation will fall, and they're going to want to cushion the downturn.
Yeah.
So when you have two scenarios, the market trades the probability weighted average of the two. Okay. So one scenario is, the 10-year is going to be closer to 5%. The other scenario is it's going to be below 3.5. Just the other scenario, the recession only has 15% probability. So it doesn't get much weight right now.
Yeah.
But if the data changes, and we got a year to go before we get to the end of 2025.
Yeah. While we're still talking about 10-year notes, I was looking at the 30-year Treasury bonds. I do every day. That's the pit I'm from back in the early 80s. And, it used to be a big deal. Maybe it's not as big a deal anymore. But, it seemed to me that anytime the market dipped below 116 handle, buyers are aggressively getting involved and pushing that price of those 30 years up. This morning, I woke up and we're at 114, heading to 113 handle. I was shocked, to be honest with you, when I saw that. And I'm thinking, there's going to be a buy of the century eventually, because you're going to get a 5% yield in the 30 year, and then you're going to get capital appreciation if you don't want to hold it for 30 years. And it might be the bargain of the century. We're not there yet. Obviously, we're still just selling off.
Yeah, the 30 years definitely worth taking a look at. Most of us now look at the 10-year just because it's the benchmark for mortgage rates and lots of other things. But the 30-year is a very important market.
Yeah. I remember a time, if my memory serves me correct, a long time ago, several years ago, the Treasury Department stopped issuing 30-year debt for a while. They picked it up again, but for some reason they stopped doing it.
And they completely stopped 20 years for a long time.
Okay. And did that was that a policy decision or just a pause based on supply and demand?
It was kind of a liquidity decision. The Treasury Department views itself as an important provider of liquidity along the yield curve. And so, but the 20-year has never really traded that well. It's got wider bid-ask spreads. The market really doesn't like it. They'd rather trade the 10 or the 30.
Yeah, well, the ultras, CME introduces the ultra, which gives you that extra average true range every day especially for day traders. Love those markets.
Yes, on the futures, you have the ultra just narrows the window of allowable bonds to deliver. And so they're much closer to actually 30 years. They're 30 years down to 29.5 or something, and there's also an ultra 10. So you've got the 10-year and you've got the ultra 10. You can deliver like an 8% coupon against the 10-year, but I'm not an 8%, 8-year, 8-year maturity. With the ultra 10, it's pretty much the on the run or barely, 9.5 years. So it's a much more precise instrument, particularly if you're thinking of taking delivery. You really don't want to take delivery of some of these off the runs. No telling what you're going to get.
Yeah, the 30-year, you could have a 26 maturity in there or something like that.
But so those were good contract innovations to refine the delivery
Yeah.
Oh, now
I'm
we're
with you
looking
on
at
that.
what the Fed's looking at. Man, this is what scared the Fed. It's pretty easy to tell we're stagnating. Inflation came down, came down, came down. Toward the end of 23, the Fed got all excited about that path down. They drew a line, thought it was going below 2%. Then they realized, whoops, the last mile is always the hardest mile. And there's some of
Yeah.
us that don't think we're going to make the last mile. Ooh, that's
Well,
cool.
when you say some of us, do you mean, are you including yourself in that?
Oh, yes. I've
Okay.
for a long time, I've argued that we weren't going to go back easily to 2%. And that's the globalization argument. That's Pax Americana is gone, supply chains have been disrupted, tariffs are coming back. None of that is good for the long-term inflation rate. So we're going to, to me, it's difficult to go back to 2%, except for the wrong reason. If you have a global or a US recession, then you'll go below 2% for a short period of time during the recession. But you really don't want to do that.
So let me ask you this though. Let's just taking a look at this chart, headline CPI. If this thing kind of oscillates around, 2.5 to 3 for a long period of time, then that becomes normal, right? And you could shrug your shoulders and say all's good in the world.
Yes, it would become normal in the sense that people with short memories would view it as the what's going on now, and they would start to accept it. People with longer memories don't like to think in normal terms because they realize that normal terms is just whatever your experience was over the last 4 or 5 years.
Yeah, but the world does change. It keeps spinning. It's different.
Well, and that's why normal is a little bit of a figment of people's imagination because the world
Yeah.
is so dynamic, such important changes from technology to policies to geopolitics that you have to be a little careful with that term new normal. It's probably
So
not going to last.
So you mentioned supply chains. There was a move afoot to near shore or onshore a lot of things that was being done offshore. Do you get a sense if that's going to continue in 2025, 2026?
It will continue, but let's just say that companies that had a plan for nearshoring may take a slight pause because, again, President-elect Trump has put Canada and Mexico into play.
Yeah.
He said, hey, I'm going to put 25% tariffs if you don't do something about the border. And then Mexico and Canada said, okay, we'll do something. But it's a negotiation. It's a bargaining chip. Mexico was the primary place for nearshoring. Well-educated, relative, slightly cheaper labor force than the U.S., a lot of trade with the U.S., but, you might want to take a slight break from that while you figure out. That was also the place where Chinese companies were buying into factories in Mexico to get
Yeah.
around the sanctions. So
Yeah.
that may still continue some. But,
Yeah. But that flow, I mean, Mexico is our biggest trade partner right now, right?
yeah, I mean, Mexico, Canada, China, these are our big three.
Yeah.
We get a lot of energy from Canada. We sell a fair amount of energy, natural gas, particularly to Mexico. It goes through pipelines from New Mexico and Texas, Permian Basin down to
Yeah.
Mexico. They use it to get rid of using diesel oil for their electrical power and use natural gas, so it's a little cleaner, things like that. We sell a lot of corn to Mexico.
Yeah.
So there's a lot of two-way trade. It's not just one-way trade. But once you start messing with tariffs, there are two kind of people the way they analyze tariffs. One kind of people analyze it as a bilateral thing. What's U.S. versus Mexico? What's U.S. versus China? Okay. World trade is not bilateral. Hasn't been bilateral for hundreds of years, but particularly the last 20 or 30 years. It's a very convoluted sense. You buy raw material from China, you get a Germany might make a part, you put them all together in Mexico, you ship it to the US, you get a battery from Canada, and then it's an automobile in the US. Man, if you analyze tariffs in a bilateral way, you will get it wrong because it just doesn't work that way anymore. The other thing is that we're in a tit for tat world on tariffs. If you do something to me, I'm going to do something to you. Again, too many people think, well, if I raise tariffs on you, you're going to raise tariffs on me. That's not what people do. They look at anything they can do that might be retribution. By the way, in an eye for an eye world, there are a lot of blind people, so you really have to be careful.
Well, I mean, we just saw this with, with the president-elect comes out and says, I'm going to put tariffs on China. And then the next day, mysteriously, China has a big investigation going on NVIDIA.
Oh, exactly. So you don't know how the retaliation's going to work, and it comes out of the box on it. I mean, back in 2018, 2019, when the first kind of tariff tensions with China started, China responded by dramatically cutting their purchases of U.S. soybeans. That wasn't a tariff thing. And of course, farmers then had a huge drop in their income, which the U.S. federal government then subsidized. Hmm. So instead of, making their money in farming, they made their money by going to the mailbox. Definitely not as good a way. And, farmers don't like that. They want to do it the right way. But, this time around, if you really put 60% tariffs on everything in China and didn't grant any exemptions, by the way, that's a big if, because last time they granted like 2,000 exemptions. But anyway, if there are no exemptions granted, guess who benefits the most? Apple gets hurt and Samsung benefits. That doesn't help the U.S. No. So, but I'm sure Apple will, well, I'm not sure actually. Apple, let's just say Apple and Tesla don't get along and one of them has more political power than the other. So I don't know if Apple gets an exemption.
Whoever makes the Apple battery we need to do better. Sorry, personal note. Oh my goodness.
Yeah, I'm charging right now while we're speaking.
Let's talk about jobs for a second. U.S. net new jobs.
Yeah, this one also got the Fed thinking that maybe the economy's doing better than they thought. We did have a very poor jobs number in October, 2 hurricanes and a big strike at Boeing. That all went away with the latest number for November. So, the red line is the 12-month moving average, and it's still very comfortably above 250, but it's going to go down. The 6-month average is closer to 200. So, we're slowing down job creation, but that's natural after the post-pandemic surge. So that doesn't suggest any negativity in the economy, but it does suggest slightly slower job growth in 2025.
But are we back on track from pre-COVID?
Yes, we're on a track now that I think we're largely we're done with the post-COVID surge. We've normalized pretty well, back to that discussion. And now we're going to slow down to what the demographics give us and the immigration, which immigration has slowed down a lot in the last 2 years. And then if we add to that any deportations, the industries that get hurt, the U.S. agriculture industry, U.S. hospitality industry, and construction. Those are the 3 industries that probably have a little more dependence on immigrant workers than the others. We don't know what will happen.
Is that going to drive up employment costs then?
Well, if you deport 1 million people, for sure.
Yeah. I don't, I think there's a lot of rhetoric and a lot of saber rattling and a lot of meeting in the middle. So hopefully it won't be that drastic.
Well, we'll see what happens. But, we back to our little discussion on the budget. We'll see what compromises emerge or don't emerge. If we don't get a compromise by Saturday evening in the midnight and the government does shut down, that tells you that any policy is going to be hard to compromise on.
Yeah.
So it'll give us a little bit of a sense of how tough things are going to be. But we get a new Congress on January 3rd.
Yeah.
And the whole deal about slight change, but the debt ceiling goes into effect on January 1st. It was suspended in a bipartisan way, so it wouldn't be part of the election. So neither the Republicans nor the Democrats had to talk about it. But President-elect Trump reinserted it last night as, hey, well, maybe we should get rid of that now, or raise it now. Let the Democrats raise it. I don't want to raise it.
Well, it's a silly thing. I mean, the same people who established the debt ceiling then suspend the debt ceiling.
Well, the debt ceiling used to be a non-event. Just for a quick 60-second history lesson, it was imposed in World War I. There is a clause in the U.S. Constitution that the Congress has to approve every issuance of debt. And during World War I, as the U.S. entered the war at the end of the war, there was a lot of new debt issue going on, and Congress got tired of approving every one of them. So they said, look, we're automatically approving everything that's under this debt ceiling. And then after that, they just kept the debt ceiling going up when they needed to. And there used to be something called the Gephardt rule. He was the House majority leader. And Dick Gephardt, great guy, by the way, he's now a venture capitalist. But anyway, Dick Gephardt said, look, every time we pass a spending bill, we're just going to raise the debt ceiling as part of the bill. And that was all great. So it wasn't an issue. And then during the Clinton administration, Newt Gingrich blew it up. And he said, we're going to make the debt ceiling a political issue every time it comes up. And here we are. We're the only country in the world that does this. Nobody else does it.
Yeah. I mean, this is like the Friday night dilemma. All right. I'm only having 2 martinis tonight. All right. I have my 2 martinis. And within 5 or 10 minutes, I'm going to probably suspend that rule. And I'm going to have a third one. I mean, come on, man. Crazy.
Well, if you look at the U.S. debt, we're at 36 trillion. If the individual tax cuts are renewed, as they probably will be, that debt's going to go up some more. If you were to cut corporate taxes another notch, which would be a separate piece of legislation, the debt's probably going to go up a little more. But there are at least probably 10 to 20 Republican congressmen in the House that have never voted for a debt ceiling increase and never will.
Mm-hmm.
And the Republicans only have the narrowest of margins. So they need a little bit of Democratic help. And so if they want to keep the government running and pass, that's the budget question that's coming up Saturday night. And if they want to raise the debt ceiling, they're going to need a little bit of compromise. And the question is just how much. We have no idea. We thought we had a deal. Maybe we don't.
Yeah. And it's so dangerous doing this 2 days before Christmas. I mean, these folks want to go home. They don't want to be dealing with this. And so that now it could get very sloppy, and concessions could be made more easily than normal, I would imagine, being human beings involved.
They did go home. I think it was 2018. We have had a shutdown over Christmas.
Yeah.
So it's unfortunately there's some precedent. So they want to go home, but it's not clear they're going to do their job before they go home.
So now that you introduced the debt into the conversation, you did it, not me. And so does that create political pressure on the Fed to lower the debt service by lowering the Fed funds rate?
It might. No. Let's just say no. The Federal Reserve knows that the debt ceiling has to be raised or suspended. It might take 6 weeks, it might take 4 weeks, it might not happen until July, because that's when it bites. Under the current legislation, it goes into effect January, but it won't bite until July. Okay. But the Fed knows that will be, because if you put the U.S. Treasury market, the largest market in the world, in default, you're talking about huge global recession. By the way, the last time we came close on the debt ceiling was 2011. That was July, August. President Obama was in office then. And the compromise was, okay, we'll raise the debt ceiling, but we're going to control spending and only can grow about 1% a year for the next 4, 5, 6 years. And it really did control spending. The deficit went down every year after that for the next 6 years in Obama's presidency. So you sometimes get some compromises that actually work pretty well.
Yeah.
Unfortunately, we have a very different Congress now than then.
Yeah. No, I know. Yeah. I mean, we live in interesting times. Let's just put it that way. We have a weird situation where we have the head of Doge, whatever that is, working for somebody who says, "Yeah, no more EV subsidies." There should be a little tension on that issue.
Well, EV subsidies used to help Tesla when it was the only game in town.
Yeah.
Now it's the high price game in town. The subsidies don't really help Tesla. They help Tesla's competition. So it's no surprise.
Okay. Okay. I don't have one. I have an old Honda Accord. It still runs. I like it. I put gas in it. I get to point A to B.
Hey, point A to B is what matters, you know?
Yeah.
But,
My flashy midlife crisis cars are way behind me.
mine too. No doubt about that.
Yeah, no, for sure. In any event, well, we covered a lot of ground. Any other last second issues we should be talking about?
No, I think we've covered the ground. I mean, it's just going to be we will not know until the period January 20th, for about the 30 days after that, whether or not tariffs are a bargaining chip, how fast deportations can occur. We may know sooner about the debt ceiling, but I doubt it. So we got a lot of stuff going on over the holidays, but I would ignore that, enjoy the holidays, and come back in January and figure it out.
Okay, so the main takeaway then, again, is Saturday night, whether or not the government's going to be operating or not.
And what compromise might or might not occur. But if there is no compromise, it throws it into the next Congress, and also to the next president.
Yeah.
And you can kind of guess which party would like to do that.
Yeah, no, I hear you. But also Friday, though, I forgot to mention this to you. I think Friday we have PCE coming out as well, right? Which, unfortunate timing for the Fed, but that PCE number, that's just last month's data, right? So it's more contemporary.
It's November data. It typically follows whatever happened to the CPI, which we got last week. I just one last thought on that quickly is people talk about the monthly rate, if it's 0.2% by month, what you've got to do is do some quick multiplication, ignore compounding, and multiply by 12. So if it's 0.2 times 12, that's 2.4%, and that's not 2. Okay?
Yeah.
So you really need so even the monthly numbers are going to suggest we're between 2.5 and 3. The PCE headline, the all-in PCE is slightly below 2.5, and the core PCE is currently just above 3. So there's a big range between the headline and the core on the PCE. So you might want to just average those two while you're at it. But I really suggest suspending the rule and having another drink.
Well, you know where I fall on that one. Any event, Blue, I appreciate you doing double duty for us this morning. I know you're super busy, but thank you for being with us, and happy holidays to you and the family.
Happy holidays.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.